Hello, I'm John Noble, and this is TIO Markets. Today we're going to do an introduction into the stochastic oscillator. Very exciting. Before we get into it, let's go through the legal disclaimer. And at this point, it's advisable that you perhaps pause the video and read through the disclaimer so that you understand. Okay, I'm John Noble. I'm a professional a trader and an investor, and I'm sharing with you my experiences and some knowledge that I've acquired over 21 years. I started my career in New York as a financial advisor with Morgan Stanley. I qualified to manage futures funds, commodity trading, operate commodity pools by the U.S. National Futures Association. I certified as a portfolio manager and investment advisor by the Cyprus Ministry of Finance. A stochastic indicator it's an oscillator, and what that means is it oscillates, means it goes between an extreme low to an extreme high, and it helps us measure that where today's price had closed relative to the closing prices or values that is over a particular period. So it's a very popular indicator which is used throughout technical analysis in various forms such as RSI, and again it's a momentum indicator. So it's displayed as two lines. There's a main line called the percentage K and a second line called percentage D. Percentage D is a moving average of percentage K. Don't worry, we're going to get more into it and things will become a little clearer as we go through the current slides. So it does produce buy and sell signals, as well as it gives warnings or a signal or an alert that a trend may be about to end. So it's a tool which is used that could help us identify not only buy and sell signals, but also when a trend is stalling or about to reverse, or a new trend is going to be about to begin. So let's get into it here. So the theory behind this indicator is that prices tend to close near the upper end of a trading range in an uptrend. So let's go to our drawing tools here, and let's look at, say, this uptrend that's here. So what is the theory saying? The theory is saying that prices tend to close higher in an uptrend, or near its high in an uptrend. Fair enough. And in a downtrend, the opposite, that prices will be closing closer to its bottom or its lows. So the stochastic oscillator, which is shown below price, it acts as a smoothing device. Let's put this, that's generating signals. Here we can see top on prices, top on the stochastic oscillator. We'll get into the more and on how to read this in a minute. So as the trend matures, the tendency for prices to close away from the high of the session becomes more pronounced. So in a downward move, this would hold true as the opposite. So let's get into this, because at this point it's still probably not that clear to somebody who's new to the stochastic oscillator, but we're going to smooth it out for you. So the stochastic indicator can be found on the MT4 under indicators, oscillators, because it is an oscillator. It's not a trend, it's an oscillator, and you have stochastic oscillator. So once you find that on your MT4, it will come up as such. Let's focus on this area. Here we can see price. Here we can see our stochastic indicator. And it ranges from 0 to 100%. So this would be 0, and then this would be 100%. So, and it's giving us signals similar to the RSI, where buy signals below 20 and sell signals above 80. But there are some rules here. It's not just because as soon as the stochastic indicator is below 20 or above 80, does that mean that we need to rush into the market or buy and sell? No, 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 no. That's not how this works. This works by confirmation. We need to see here, and we're going to repeat this a few times. This is the confirmation here. You have prices above and below. On that second break is where we get a confirmation, and again, you can see it down here. So you wouldn't be selling on the break or buying on the break. You'd be below, you'd be buying on the break above. So a reading of 0 shows that prices closed at the lowest level during a preceding time period. Let's say in this it's daily. And a reading of 100% shows prices closed at its highest price during a particular period. So we have percentage K, which in our example we're going to show 10 periods. So percentage K is a number of time periods. So it could be 10 hours or 10 days or 10 weeks or 10 months, whatever you put here. A percentage K slowing periods, which will be here, where 1 would be fast, 3 would be slow. And then your percentage D, so it's a bit clearer. You have your percentage D, which is a moving average of percentage K. So let's say today's close, the calculation is as follows. It's the today's close minus the lowest in percentage K's periods. So if we're looking at 10 days, we're looking for today's close and then going back 10 periods to see what the lowest percentage K is. Then we're dividing that by the highest price in whatever time periods we're looking at, minus the lowest price, and then we times that by 100. Complicated enough? Well, if you were using pen and paper and doing this manually, yes. But if you were, if you're relying on the software or the processing ability of your computer and the MT4 platform, you don't have to worry about that because these calculations are done for you. So an example would be like, let's say if today's close is 10. Let's say it's $10 or 10 euros. The lowest close in the past 10 days is 7. The highest in 10 days is 12. So we would take percentage K minus equals 10 minus 7, which gives us a number of 3, divided by 5, which is the high and the low, gives us 5 times 100. This would give us a percentage K reading of 60. Okay, let's do that again. So here we have percentage K period is 10. So this is 10 days or 10 candles. The lowest close in 10 days is 7. That means that in the lowest price in the last 10 days was 7. The highest price in 10 days was 12. And the lowest, 10. So percentage K equals 10 minus 7. So the highest price, or today's close was 10, minus the lowest, 7, gives us 3. And then you have the highest price of 12 minus 7, gives us 5. So we take 3 divided by 5 times 100, gives us 60. So that's the formula behind the math or the calculations that's being done whenever you load a stochastic indicator on your MT4 platform. Again, it's not something you need to know. The calculations are done automatically, but it's to understand an indicator and how it works and its signals. It's better to have a clear understanding of the calculation behind it. So let's put a bottom line to this and make it simple. So the interpretation is we're buying when percentage K falls below percentage D and then rises above 20. So where's our buy? Our buys are going to come here. You're going to get an alert. This is 20. You're going to get an alert when the percentage K falls below 20. You're not going to do anything, but your buy signal will come when price breaks back above 20. So you're going to get an alert, and then you're going to get your signal. Again, here, you're going to get your alert, then you're going to get your signal. Alert, and then you're going to get your signal. Sell, it's going to be the same. You're going to get your alert, then there's your selling signal, and you can see prices here. You have around here is where we got our alert, and then we got our sell signal up here. And again, we got an alert, we got a sell, there's a bit of a whipsaw in there, and then up here again, you're getting alert, and then you're going to have to wait a while until you get another sell signal here. Buys. So a buy is when percentage K, percentage D fall below 20 and then rise above 20. So again, let's repeat it. We're going to focus on this area for the buys. You're going to get an alert, and then you're going to get your buy signal. And then you can see the reaction on price here. Buy when percentage K rises above percentage D. So another one is where we can see a cross. You can see percentage D, percentage K, and you're going to get a cross. When the lighter blue line here, this is going to be our percentage K, percentage D. When you get that cross here, that's going to give us another signal. Sell signal is going to be the opposite. Here we're going to see our warning and then the actual signal. And it's very nice to see how that works. This is the warning, this was our signal, and then this was price. Again, you got multiple sell signals here because now we have also the cross. You can see when percentage D crosses below percentage K, we get another signal and another signal, and it looks like where we are now is probably, well, not yet confirmed, but perhaps another signal. So it's very nice. In a situation like this, a trader might be looking to add to their sell positions or add to their buy positions. So let's say if we're here, just backing it up a second, you get a signal here to buy, so you might add to your position. You get another signal, you buy some more, another cross, you buy again, you buy again. So then you could have multiple buys and participate and compound your position as the trend builds up. The same can be done for the downside. Here you're going to get a signal, 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 and you can participate and compound that position to the downside to get the most out of the move. Divergences is another thing to use stochastic oscillators for. Divergence between the stochastic oscillator and price resolve when prices rally. So what does this mean? It means if we're looking at the oscillator here, we can see that we're getting higher bottoms. Price isn't doing much, it's relatively flat. This should give us a warning that prices are trying to advance higher. And then at the same time, you can see that you have prices divergence where you had prices falling here, and you had the stochastic oscillator rising, and then we had that very nice breakout. So the looking for divergences is where we can get very nice breakouts right across this level here. You can see how nice prices touched, and then broke out, and then you get that massive move. So divergences, very, very powerful, and the stochastic indicator can help us spot these divergences in price. So the conclusion, the stochastic indicator is a momentum indicator that attempts to measure the points in a rising and falling trend. Buy-sell signals are generated on crosses, and look for divergences for signs of breakouts or a trend reversal. Questions on stochastic? Contact TIO Markets to find out more. Thank you.